Question 81. A junior fund manager at Dapper Assets Management is constructing a portfolio consisting of a few large cap stocks that trade on the London Stock Exchange. In a meeting with the investment committee, the manager was asked to present the risk associated with the stock of ATT. The returns of the stock for the past 7 years are shown in the following table. So we've got 7 years worth of data and the returns in those years. Using the given data, the standard deviation of the stock is closest to. So one way to do this is you can go through and use the big long formula that you can see on Analyst Prep website to go through and calculate this. A little bit quicker of a way, I'll show you using the calculator. So essentially what we can do is we can use our data function. So I'm going to hit second data. And what we do is I use X. So under X, we plug in all these different values that we have in this table. So I've got 17, 21, -8, -1, 4, 19, and -7 for the last year. And then once we have all this data in here, make sure you don't have any extras in there. What we can do is we hit second and stat. And essentially this is going to start calculating some variables for us. So we've got our N of 7, so 7 observations. X bar, which is our mean, I believe. And then here's where we get standard deviation. So standard deviation, this is of the sample. So this would be N-1. And then we have here population standard deviation, which is going to be calculated using just N. So in this case, we're given the returns of the stock for the past 7 years, and that's what we're calculating standard deviation on. And so in this instance, we're going to be using the population standard deviation, so 11.53. Answer B. Question 82. The standard deviation of an asset's return is 10%, and the standard deviation of the market's return is 14%. If the correlation of returns with the market index is 0.7, then the beta of the asset is closest to. This is going to be a pretty straightforward calculation. We need to remember our beta formula for this. So we're going to take beta is equal to correlation, which we're given at 0.7, and then we're going to multiply that by the standard deviation of the asset given at 10% divided by the standard deviation of the market return given at 14%. So it gives us 0.7 times 10 divided by 14, which equals 0.5. It's going to be answer B. Question 83. If an investor is interested in knowing the real return his portfolio has earned over a certain period, assuming that the nominal return of his portfolio is 18%, the CPI is 6%, and the tax rate is 38.9, then the real return of the portfolio is closest to. So one thing that's thrown in here is the tax rate to throw you off. When we're looking at real return, we're not going to be considering an investor's tax rate. That would be included if we were looking at after-tax return. But under real return, we want to know CPI and the nominal portfolio return for this calculation. So our real return is this formula here. So real return equals 1 plus nominal return divided by 1 plus inflation. So we'll do that in the big parentheses, and then we subtract out 1 at the end. That gives us our real return. So this is pretty much plug and play here. So we've got 1.18 for our 1 plus nominal return divided by 1.06 for our 1 plus inflation. And then we subtract out 1, and that gives us 0.1132, which is going to line up right here with answer B. Question 84. Distributed ledger technology, DLT, has the potential to accommodate smart contracts. Those smart contracts are most likely A, computer programs that self-execute based on pre-specified terms and conditions agreed to by the parties to a contract. So we've got contract right here in the name, and this does sound like the definition of a smart contract. In these smart contracts, we have the terms set ahead of time, and they just automatically execute for those parties. So A sounds like it'll be our answer. Let's make sure we can rule out the others though. B, a digital currency created in January 2019 by the mysterious Satoshi Nakamoto. This is not DLT, that is Bitcoin. And C, computer programs that follow trends and patterns of money invested by people with expert knowledge. This sounds like it's talking about some type of algorithmic trading or other type of investing strategy, essentially, not a technology that would constitute smart contracts. So we can stick with answer A here. Question 85. The table below illustrates expected annual risk and beta data concerning 3 textile manufacturers, A, B, and C. So we've got A, B, and C here, expected annual standard deviation and beta. Out of the 3 manufacturers, the highest total risk is closest to 0.065, 0.101, or 0.318. So for total risk, the variable that we're going to want to be looking at is not given here, which is what makes this question a little bit difficult. I think right off the bat, we might go for standard deviation and choose answer C, since that's right there. However, for highest total risk, we want to be looking at variance, not standard deviation. So what we need to do is take each of these standard deviations and we will square them in order to get variance. And when we do that, we get a variance of 0.065, 0.1011 for B, and 0.0367 for C. And so that brings our highest total risk not as C, but to answer B, after we've adjusted that to variance. Question 86. Which of the following return-generating models most likely uses macroeconomic indicators such as GDP growth and inflation, along with fundamental factors such as earnings and earnings growth, to forecast future value? A, market model, B, revenue model, or C, multi-factor model. So market model, this is not going to be using these types of variables. The market model is just going to be looking at, it's going to use a model based on the market. So it's going to be looking at our returns and relative to how the market is doing. So telling us kind of what our sensitivity is to that, not looking at other indicators like macro or fundamental factors. So this is how we end up with something like beta, where it essentially just tells us our sensitivity to the market. B, revenue model. This is going to be used more in the context of business strategy, not necessarily a macro or fundamental factor model to forecast future value. It's going to help businesses look at and determine what business lines or different pricing strategies to look at in order to increase or optimize revenue. But it's not going to be used in this context described up here. And then C, multi-factor model. It's kind of right there in the name, multi-factor. If we're using different types and multiple factors, they could be macro, they could be fundamental. Answer C is going to be what we're looking for. Question 87. Which of the following is most likely a method of detecting and overcoming loss aversion bias? So before we jump into these answers, loss aversion bias is essentially where a person or investor is more prone to disliking losses more than they like gains. So a $10 loss for me might hurt me more or feel more psychologically difficult than acquiring a $10 gain. So that's kind of what loss aversion bias does. So what this leads to sometimes is when we have an investment that's down $10, we have a really hard time cutting that loss, even if the fundamentals of the position are not doing well and there's a reason that the stock is down. And once a stock is up, maybe $10, to go back to that same example, we have a harder time holding on to that because we don't want to lose our gain. We want to lock that gain in, even though maybe that's not what we should be doing based on the fundamentals and whatnot. So what's a way to kind of detect this and overcome that? A disciplined investment approach. I think this could be our answer right off the bat. This does seem like a way to overcome loss aversion bias. If in our investment process we are more focused on the fundamentals of the business rather than the gain and loss that we have based on the price that we bought at, we can hopefully be more objective about buying or selling based on the underlying business rather than our stock profit and loss. B, fearing that profits may diminish, selling investments in a gain position much earlier. We can rule that out. This is generally a symptom of loss aversion bias, so it's not a way to deter it. If we make a profit in a stock, we're worried that we're going to lose those profits, so maybe we sell it earlier than fundamentals might dictate. C, using fundamental analysis to keep investments in a loss position for longer than necessary. Again, this is a symptom of loss aversion bias, keeping a position longer than we should if the fundamentals are deteriorating. If the fundamentals show that the stock is still good, then maybe we do want to keep it, but we don't want to keep it longer than necessary if it doesn't. So I think A, disciplined investment approach is our best answer here. Question 88. Which of the following key factors of the risk management framework most likely involves the quantitative assessment of potential sources of risk and the organization's risk exposure? So which of these is the quantitative assessment of potential sources? So kind of identifying potential sources and what the organization's risk exposure is. So is it going to be A, risk infrastructure, B, risk analysis and integration, or C, risk identification and integration? So these are a little similar in the integration component. Infrastructure we can rule off right off the bat. This is going to be the part of the framework that's more focused on the organization's makeup within and how they delegate tasks more so. So what is the infrastructure of the organization and how do they go about doing this quantitative assessment and who's responsible for that and how do we track it and stuff like that. It's not necessarily doing the assessment itself and identifying risk exposure. It's kind of how are we going to do that and implement it more so on the infrastructure side. So then between analysis and identification is going to align more with what we're doing here. So we're going to be doing the assessment and understanding what the risk exposure is. And then the analysis is going to be taking that one step further where we're looking into that data and looking into that quantitative data and kind of understanding what they could do to mitigate that and do things differently going forward based on the risks that the organization wants to have. And so they're obviously both still important parts, but answer C is going to line up more with what we're asking for in the question. Question 89. Which of the following portfolios is or are most appropriately priced? Portfolios 1, 2, and 3, and we need to look at these and then determine which of them are appropriately priced. So only portfolio 2, or are portfolios 1 and 2 appropriately priced, or are 2 and 3 appropriately priced? So looking at portfolio 1, a portfolio with an estimated return above the securities market line. So a portfolio above the securities market line is going to mean that it has a higher expected return. And so for it to be above the securities market line, it would have to be undervalued for it to have a higher expected return. So that type of that security won't be appropriately priced since it will be undervalued. So looking down at these answers, we've got portfolio 1 and answer B, so we can rule that out. Portfolio 2, a portfolio with an estimated return plotted on the SML, the securities market line. That sounds correct. If the portfolio is on the SML, it's going to be appropriately priced. And then C, a portfolio with an estimated return below the SML. That's going to be the opposite of portfolio 1, and this portfolio is going to be overvalued if it has a lower expected return than the securities market line. It's going to be overvalued, and so we can rule out answer C since that has portfolio 3 in it, and we'll go with answer A. And so essentially our conclusion is if we're on the securities market line, that indicates that we're appropriately priced. If we're above or below, that's indicating that we're over or undervalued. Question 90. Damascus Trading Corp is a shoe manufacturer in Syria with a risk-free rate of 5%, a market return of 10%, and a beta of 1.2. The resulting cost of equity capital is closest to. So given the variables that we have, it looks like we're going to be using CAPM to calculate our cost of equity capital. So pretty straightforward formula here. We've got CAPM equals the risk-free rate plus beta times equity risk premium. So our risk-free rate is given at 5%, beta is given at 1.2, and equity risk premium will be imputed by the market return minus risk-free rate. Since we're not given equity risk premium, we're given market return. So we've got to do 10 minus 5 to get that. So when we work that through, it gives us 11%, which is going to line up right here with answer B.